We are now going to talk about what it means for something to be capital in nature. So if we go back to the gross income definition, remember that it tells us that it excludes items that are capital in nature. So what does it mean? It means that if an item is considered capital in nature, it will not be gross income. So in other words, capital items are not taxed under gross income. Capital items might be taxed under capital gains tax, but not under gross income. And it might not be taxed at all then. So, what does it mean for something to be capital in nature then? Now this is probably the most challenging of the gross income sections, and is also the most popular to be asked if they do ask a discussion type question. And it's also probably the most interesting of the sections, because this is where we see a lot of interesting little nuances of how the Act can be read and situations can apply. So this is a section that has very principle driven. There's very few specific rules, so there's very few hard and fast rules about what it means. So the Act again does not give us a definition for a word here, and in this case the word is capital. So we need to look at case law. So case laws have said, what does it mean to be capital nature? So as we get ready for now this discussion, I want you to understand that what is capital for one person is not necessarily capital for another. So for example, if there is a place that sells cars, like a second-hand car dealership, or a new car dealership as well, so your Toyota or BMW or Honda, whatever the case might be, if they sell cars, it will be gross income for them because those assets are trading stock, those cars. But if you sell your car or I sell my car, that is not considered trading stock, because I'm not a car dealer usually. So usually that would not be trading stocks, that would be capital in nature. That's in a simple example. So a car dealership selling cars, gross income. You sell your personal vehicle, not gross income. Why? Because of capital in nature. So what is capital for you? The car is not capital for the dealership, for them it's trading stock. Now what is very important here, and you'll see I say here you can score this for an easy mark, but it's important for you to know this also, because in case you ever encounter a situation like this in your personal life. If you have disposed of something or sold something, you believe it's capital, and SARS does not, it's up to you. The burden of proof, it means you need to provide the proof. You have the duty to provide the proof. That is section 102 of the Tax Administration Act. So you'll always have to state this. The burden of proof lies with the taxpayer, section 102 of the Tax Administration Act. So, how do we know if something is capital or not? So, they talk about intention, and they call this the golden rule. Intention is the golden rule. The taxpayer's intention. Now, basically what happens, how gross income works, and how do we know if an amount is capital nature is, and this is very important, is we look at whether or not there is what is called a scheme of profit making. Are you involved in a scheme of profit making? Now what does a scheme of profit making mean? Now this is a little bit more of a complex idea, but basically a scheme of profit making in simple terms is if you're carrying on activities and you're attempting to generate a profit through that. So I want you to understand, so this is, if you think of a business, a person that buys and sells shoes, a person that makes food and sells it, a person that goes to your house and paints it, a plumber, an electrician. Right, all of those people and businesses, all of them are carrying on activities to make a profit. You can see it's clear that they're carrying on a scheme of profit making. That's what you would expect. So it's like a business type of activity where you're doing things, and the things that you're doing, you can see there's a clear attempt to get profit. It doesn't mean that you have to generate a profit. So not all situations where a profit is generated is also a scheme of profit making. So what I also mean before that, doesn't mean you have to generate a profit. If you're doing things and you're making a loss, but you're still trying to generate a profit, that's also still considered. But also there are certain situations where you make a profit, but it's not considered a scheme of profit making. So for example, if you're selling your house, and you're trying to get the best possible price for it, so you're trying to get as much money as possible out of it, that might seem like a scheme of profit making, but it's not. You're just trying to dispose of an asset at your best advantage. You are allowed to do that. You are allowed to take your assets and try and generate as much value from it as possible. That's different from carrying on a scheme of profit making. A scheme of profit making is where you're carrying on more activities to do so. So for example, if you have you're trying to sell your house, and the house maybe just needs a little bit of paint, and then you can get a higher price, that's fine. But if you now go and you renovate the entire house, you break down walls on the inside, because remember, you want to sell it, but now you go and you try and break down walls and you put in hot tubs and different lights so that you can make a maximum profit, that's different. Now it starts seeming like you're trying to do activities, you're trying to turn your house, flip your house basically for higher profit. Then it starts becoming a scheme of profit making. So you can see the difference there. The one is, I have this asset with minimal effort, I can try and get a better price, whereas the other one is you put in a lot more effort to try and do it. So they will look at your intention. Now what is important is your intention. If your intention switches to a scheme of profit making, it will probably be gross income. So they'll look at at the time when you acquired the asset. So let's keep this house in mind that I keep saying. So you had a house, you stayed in it for 10 years, now you're trying to sell it for the maximum amount of profit. Okay. When you bought the house originally, the time you acquired the asset, they'll say, what was your intention then? Why did you buy this house? Did you buy it in order to use it in a scheme of profit making? Or did you buy it from another reason? In your case, you bought it to stay in it. That's not a scheme of profit making. Okay, so far so good. Then over the 10 years that you stayed in it, what did you do? You just lived there. You maintained the house, you looked after it, maybe made some small renovations for yourself to make it nicer. But that's still not a scheme of profit making. There hasn't been a change in intention. And at the time of the disposal, you just looked around for the best buyer, try to get the best selling price for it, maybe just put a little paint on it. Still not a scheme of profit making. It is capital nature. Okay, but now let's take that same house of yours. So now that same house, when you bought it originally, you wanted to just stay in it. Okay, let's say that was in the year 2002. But now over the years, you see, wow, the neighborhood I'm staying in is attracting a lot of very wealthy people. And you realize that if you make your house do some renovations, you can sell your house. So during this period, you start doing massive renovations. You put in all sorts of things to make your house, you go into debt, basically, to make your house look extremely nice. New fittings, new furnish, new taps, gold taps, crazy expensive air conditioning, indoor swimming pools with heat, whatever, just going crazy. Alright? If the courts look at that, and then they realize at the time of the disposal you were really trying to sell it to maximize a profit, they'll go and look at it's a little bit of a different situation. They'll say, well, you put in all of this money, you went into debt. For us, it looked like there was a change in your intention. You went from wanting to use it as a home to wanting to use it as an asset that you can sell for the maximum amount of value, and not just as a home. So we believe there's been a change of intention, and now it is gross income. That means the sale of the house will be gross income, but it also means the cost of the house can be deducted because it will be trading stock. Now again, guys, it's not as black and white as I said. There's lots of factors to be determined. Maybe if you suddenly had a massive increase at work, so you start making the house very nice, and when you sell it, you make a profit. That doesn't mean then it's the same situation as where you just try to make it better for the neighborhoods that you could sell it. They'll have to look at it again. What is your intention? So how it works is, the court will do two tests. The court will do subjective tests, and they will do objective tests. Now how it works is, they will first do the objective tests. The subjective test. Now the subjective test is, they'll look at you and they'll say to you, listen, explain to us this asset that you sold. Explain to us if it is in a scheme of profit making. What was your intention? So you'll say, yes, it was a scheme of profit making. If you do, that's the end of the story, it'll be gross income. But now you might say, no, it's not. I believe it's capital in nature, it wasn't a scheme of profit making. So what they'll then do is they'll start doing a couple of tests. They'll ask you things like the Fisher case, and they'll look at the Fisher case. The Fisher case said we need to do a tree versus fruit comparison. So basically what they say is, if you think of a tree that produces fruit, if a person, the owner of this tree, sells the fruit of the tree, that will be gross income. But if the owner sells the tree, the actual tree, that is capital in nature. Okay, so let me explain how that works. Let's take Coca-Cola. So Coca-Cola has factories that produce Coca-Cola. So inside there's all sorts of machines. Right. So this machine over here that you see, Coca-Cola goes and sells this machine for 100 million rands. It's the end of the year of assessment, it's cash, they've received it, they are a resident. Is it capital in nature? Now, they go to Coca-Cola and say, why did you sell the machine? Is it a scheme of profit making? Is it capital nature? Coca-Cola will say to them, if we look at the FISA case and if we apply the principles of the FISA case rules, we produce Coca-Cola, that is considered our fruit. Our assets are considered the tree. So, the FISA case says to us that the Coke we sell is fruit, so which is gross income, but the tree is the machinery that we've sold. Right, so that will be capital nature. Now, if Coca-Cola starts a different business, so they have this machine they want to sell, and they say, okay, well, let's actually start buying and selling machines for people who want to make their own soft drinks. That's a different story. Then that machine will again be a scheme of profit making. It becomes the fruit then. Then their business is the tree. Okay, but that is the tree versus fruit. So let's think about it in your house, the house that you stayed in, right? So you go to work every day, you work there, you do things. The house is where you go, personal time. Now when you sell it, if we're trying to apply the tree versus fruit principle to it, what is the tree here and what is the fruit? Now this is a bit more difficult because you not using this house at all to produce fruit. We're using it to stay in it. So therefore when we sell it, it's still going to be the tree. It's going to be capital nature. Right. Remember I spoke about a change in intention when I said maybe you bought the house originally and then you decided to start to become a property developer. Right? So, or this situation where it says you Coca-Cola had this machine and then they decided, oh well, instead of us deciding it's a tree, let's start selling machines. We buy machines and sell machines so other people can also make a cool drink. Then that is a change in intention. Now the court case there was the Natal Estates court case, which asked the question, has this taxpayer crossed the Rubicon? Alright, so now we get all fancy and stuff. What is the Rubicon? Right, so the Rubicon is a river in Italy. I am not an expert on Italian geography at all. It's a river in Italy. Basically, how the story goes or how history goes is Julius Caesar, the Roman Empire, the Roman Emperor, obviously the Roman Empire, the Emperor of the Roman Empire. He was going to declare war. So there is this river in Italy, and basically, let's say over here is Roman territory, and here is other territory, right? Whatever country or tribe it was. And basically, what happens? This is the river, the border. So they went and said, while they were on this side, they were not at war. But the moment they crossed the river, they went from not at war to being at war because they crossed the border, they invaded. So, crossing the Rubicon is a phrase we use when there's been a big change, an irrevocable change. Something has gone from one state, not at war, to another state, war. You've gone from a state not capital to a state capital, or a state capital to not capital. Okay, so have you crossed the Rubicon? You'll consider it if there's a change in intention. Now remember guys, you can go from capital to not capital and not capital to capital. They'll look at your intentions further. Did you have mixed intentions? So for example, you said, yes, I bought this house and I wanted to stay in it, but then I started renovating and I thought, if someone comes along and they sell it, want to buy it, I'll sell it, but I'm not sure if I should. So you were a little bit undecided basically. They'll then look at what was the more dominant factor, right? wanted to see more like your activities were, that you wanted to sell it or not. And if you have alternative intentions, say, I would do it like this, but I can also do it like this, it's going to be revenue in nature, right? Now, these subjective factors, they'll look at you, so they'll ask you these questions. You might then indicate it's capital. The court will then say, right, we've now listened to what you've said, but now we're going to make up our own mind. So step number 2, by looking at the objective factors. So now they will look and say, in spite of what you've said, let's look at a couple of objective factors. Now what I want you guys to understand is, this is not a complete list. They can do any test here, any indication. So they'll try and look at your life, your personal situation. So for example, let's use this as a quick example. Okay, it's similar to a lecture example. This is a plot of land. Land in KZN. Right, so in KwaZulu-Natal at the coast. Here's the ocean. It's very nice. You can see a nice ocean view. Mr. X is an auditor, or used to be an auditor. He's now retired at 65. Mr. X says he sees this plot of land. There's a house on this plot of land. It's a massive piece of land here, much smaller house. Okay, he says, he is based in Johannesburg. He says, I want to move from Johannesburg down to the coast in KwaZulu-Natal. I want to go and stay in this house. I've always wanted to have a house that can see the ocean. Okay, now he goes to the owner. He says, I want to buy the house, but he says, but listen, but this land is way too big for me. I don't want this land. But the seller says, listen, you take the whole house, the whole land, or it's not for sale. So Mr. X says, okay, fine. And he buys this for 10 million rands. He says, maybe I'll handle it. Okay, so he buys the house for 10 million rands with a whole plot of land. After a year, he realizes this is crazy. He can't keep up. This land is just too big. It's getting crazy wild in there. There's animals in there. It's just dangerous on this piece of land. So he goes and he applies to have this subdivided, the land. So he says, I'm going to just take that piece of land, this land over here, I'll keep. The rest of this I'm going to sell. Okay, so he keeps this and he manages, because a year has passed, to sell this for 12 million rands, this extra piece of land. So it's just an empty piece of land. Now, is that capital nature? So let's quickly go through it. Subjective. They'll ask you, were you in a scheme of profit making, or is it capital nature? So Mr. X will say, listen, I wanted to just buy this house. The land was too big for me. That is why I had to sell it. So that is my intention. The land was too big for me. I couldn't maintain it. I originally even told the guy, I don't want to buy the whole land, but it's the only way I could have this house. So his intention, tree versus fruit, is not really applicable because he's not using the house to generate fruit. Okay, so it's not really applicable. Has he crossed the Rubicon? So you have to ask yourself, when he went and he subdivided this land here, did he cross the Rubicon? Did he go from a person who bought a piece of land that's too big for him to a person that is selling an excess piece of land as a property developer, or as a person that's now going to sell things? He's retired. He hasn't bought other pieces of land. Subdividing it is filling in a couple of forms. It's not that expensive. It's not that big a deal. So subdividing the land is just a way for him to dispose of that asset. It's not a change in intention. He has not crossed the Rubicon. He had no other intentions and views here. Right, so let's look at his objective factors. His occupation. He used to be an auditor. He's now retired. Is he a person that buys and sells properties? No. So from that perspective, it looks like it's capital nature. Frequency of transactions. How often has he bought and sold property and stuff like that? So when he retired in Johannesburg, yes, let's say he sold a property there, so a year or two ago, and now he's selling another one. So it's a little bit frequent, but we can see the situation is different here. It's also the first time that he sold just a plot of land, an empty land there. How did he acquire this? So basically, how did he buy this plot of land for 10 million? Now, if he bought it and he went to the bank and he said, listen, I want a short-term loan because I believe I'm going to sell the property in a couple of years, that's maybe a bit different. But he took out savings, a bond, and he paid for it in that way. It's not the way which a business which has a short-term scheme of profit-making would do it. How did he dispose of it? He just subdivided it and sold the excess land. Yes, he made a bit more extra money, but you're allowed to sell it at your best advantage. How long did he have it? Short. Now, usually if something is short, guys, held for a short time, think of Pick and Pay if it buys goods to sell, holds it for a short time, sells it. That's usually a scheme of profit making. So that would lean towards a scheme of profit making. But again, we can't expect this guy to have stayed in the place for 20 years, drowning in costs before he sells it. So we can see there's other factors. How would he treat it for accounting? Well, if he had a business or something there, he would probably treat it as a sale of empty land. Is it fixed or floating capital? Again, that has to do with trading stocks, not really trading stocks, so it's fixed capital. So I want you to see any other tests there, guys. Nothing really else that I can think of that's here. I want you to see though, if you now look at the probability, so some of them were saying capital, one or two of them were saying scheme of profit making. Overall, you have to look at it for a feeling. There's no if 5 out of 6 is met. It doesn't work like that. It might be that most transactions are saying capital, but there's one that's a big issue that sways the whole thing. Right. It doesn't need to be like that. So in this case, that 12 million will probably be capital. But while we're on it, let's now talk about it. So what happens if, before he sells it, so remember he subdivided it here, so before he subdivided it there, his friend says to him, listen, don't subdivide it like that for 12 million. Instead, subdivide it like this. So turn it into 9 plots of land. Then when you sell them, you can make 15 million in total. Now, let's go through it again, quickly. What is his intention? He wanted to sell the excess piece of land. Has he crossed the Rubicon? That's now a big consideration. Now it starts being consideration. What has he done now? Instead of just subdividing it once, he subdivided basically into 9 pieces. And he sold it and he made a lot more money. Now, can you say that subdividing into more pieces to get a lot more money, 3 million extra, can you say that that's a scheme of profit making? Yes, he's definitely selling it for more money. But subdividing it and doing that. Remember, it's still an empty piece of land here. There's just 9 people can now buy it. That is still just selling it at his best advantage. All of the other factors will still agree. It's not considered capital nature. Or a scheme of profit making. It is considered capital nature. But now let's change it a little bit further. His friend says to him, listen, when you subdivide it, I want you to also put in this blue over here, represents water pipes, connections, and this purple here is electricity. So I want you to put in sewers, water connections, and electricity. That is going to cost you an extra 5 million, but instead of selling it for 15 million then, you can sell it for 30 million. Right. So Mr. X does it. It takes him 6 months to put in electricity, to get everything signed off, put in electricity, put in water. Now let's go through it. What is his intention? He said, I bought a piece of land. I wanted to sell it because it was just too big for me. So they say, okay, cool. But now let's look at what happened here. You subdivided it, which is we not have a problem with. But you actually then went, remember you were complaining about the cost. You actually went and you spent an extra 5 million rands. It took you 6 extra months to a year to put in everything. You had to get contractors out, sign contracts, all of those things. Now to us, it looks like there has been a change in intention. You have crossed the Rubicon. You went from a person that's trying to just sell a big piece of excess land to a person who has developed land. So you're a property developer and who's now selling it to people who can now build townhouses and things there. So you've crossed the Rubicon. This entire piece of land, because she's selling it now, is the fruit as well, because it's now stock for you. So you've crossed the Rubicon. In spite of all of these other factors that we saw here, we can see that your intention has changed, and therefore this is considered a scheme of profit making and therefore gross income. Right, so guys, that's a lot of the things which I spoke about there. The Visser case. So the Stott case is the one that spoke about intention. It says the intention is very important, unless there's been a change in intention. And please remember, this case also says you can realize it to his best advantage. I mean, you can sell things for as much money as you can, but it's different from becoming a property developer or changing into a scheme of profit making. We had the discussion about crossing the Rubicon and changing intention, and there must be a scheme of profit making for it to be revenue. So guys, before I move on, let's talk about a couple of other situations. Your aunt passes away and she leaves you 1,000 rands. Now, is that gross income? Did you receive it during the year of assessment? Yes. Is it cash? Yes. Did you receive it? Yes. For your own benefit? Are you a resident? Yes. Is it capital nature? Now, are you involved in a scheme of profit making with that? No. You didn't murder your aunt in order to inherit money. It is what is called a fortuitous gain. Fortuitous means lucky or by chance gain. Right, so that is not considered a scheme of profit making. What about the lottery? You enter the lottery, the lotto, and you win. Is it a scheme of profit making? Okay, now, you might think yes it is, because think about it, all of us go and we enter the lotto with the hope of winning money. We spend money to get it. But can you say it's a scheme of profit making? So this is now the concept I want you to understand. To be a scheme of profit making means you have to be able to carry on activities that has some sort of reasonable chance of getting to that outcome. The lotto is completely by chance. So yes, buying a ticket gives you a bit of a chance, but you can't say if I buy one ticket or if I buy 1 million tickets I can definitely win it. You still don't necessarily can't win it. So it's also considered fortuitous. So if you enter any competition where there's a lucky draw, not gross income, it's capital nature because it's fortuitous. It's not a scheme of profit making, even though you hoped to win. Okay, now there's another one. You go to the casino, you put money in a slot machine, you win. Capital nature or gross income? Yes, you wanted to win. Again, too much luck. Capital nature. It's considered capital nature. Poker. I'm an amateur. I just know how the game works, but I'm not a professional poker player. I go and I play poker, and I win. Is it gross income or capital nature? For me, it will be a fortuitous gain, so it will be considered capital nature. If you go and play against a professional poker player, now again there is luck, but go and play against a professional poker player, they will destroy you. Why? Because there's skill to it. So for them, it's not so much fortuitous, it will be considered a scheme of profit making. They're professional at it, therefore it will be gross income for them. You go and bet on the horses, right? So I go and I bet on horses and I win. Capital nature for me. But the owner of the horse, for him, he's trying to use that horse to generate a profit. For him, it's a scheme of profit making. Yes, there's other horses that he has to compete with, but he can put in a lot of effort. He can say, I train the horse, exercise, give him the right food, I keep him healthy, the right medicines. Therefore, I'm carrying on activities to do so. You go and you compete in a game show like Who Wants to Be a Millionaire, if any of you young kids can remember that. Basically, they'll ask you a lot of random questions. Right. No person can be considered as expert in everything, so if you do win it, it's fortuitous, it is capital nature. Now they have a game show where they test history, in-depth history. A history professor goes and wins, obviously, because he knows history really well. That will be a scheme of profit making. Okay, so as you can see, guys, it really is very much a gray area. When you get to an exam situation, it is your arguments that will be judged. Even if your final answer is not the same as theirs, if you made valid arguments, you will get the marks. Again, you can't just put down principles and have a crazy argument. Remember, some people can have arguments which make no sense. If you make no sense, you won't get your marks, but if it makes sense, you will get the marks. State the rules. Go state the facts that you'll have to consider the intention, and then the objective and the subjective factors, guys, and this is very, very simple. Also, do make sure to look at your lecture examples.